Today we're talking taxes, and there are a number of tax bills that are being looked at by the House and Senate. The House just passed their bill on Thursday, November 16th. The Senate will be looking to pass their bill sometime after Thanksgiving. And interestingly enough, the bills are similar, but a little bit different. And if you look back, the last major tax reform was in 1986, the Tax Simplification Act. That was under Ronald Reagan. But I wanted, for purposes of this video, I want to talk about the differences between the House and the Senate plan. Because in the House plan and the Senate, there are some similarities, starting out with the standard deduction. So standard deduction goes to $12,000 per individual, $24,000 for a married couple. Although personal exemptions are eliminated, state and local tax deductions, those are eliminated. So if you're in a high tax state like California, for example, and you're in the highest bracket, your taxes will actually go up. Charitable contributions would be retained, but alternative minimum taxes would go away. In other words, there would be no such thing as alternative minimum taxes. Those are some of the major things that are the same. There's some fairly major differences, though, and when you look at the Senate plan, they want to retain the current mortgage interest law, which means you can borrow up to $1 million to buy a home, and you can deduct all that interest expense as a deduction. The House plan, which was recently passed, wants to lower that limit to $500,000. So you can only borrow up to $500,000 and take a full deduction. The Senate plan also has the medical deduction retained. So if you have high medical costs or you're retired or say in a long-term care facility, you can still deduct all those premium payments or monthly payments that you make. And then the estate tax would not be repealed in the Senate plan, although it would double from its current level. So right now, if you have $5.5 million of assets, it would pass to the next generation tax-free. If you're a married couple, it's about $11 million. That would double to about $11 million per person or $22 million for a married couple. In terms of corporations, both plans have the corporate rate going from 35% to 20%. And by the way, the reason they're doing that is they're trying to keep more profits in companies. So the companies will expand more, have more money to hire more people, create more jobs, improve the economy. That's the thinking behind that. In terms of small businesses, that tax rate would be reduced as well. But the Senate has a different formula than the House in terms of how they come up with that reduced rate. It's actually a little bit more complicated, but we'll have to see if what happens. As a reminder, the House did pass their bill. The Senate is going to be looking at passing their bill sometime after Thanksgiving. It will be much more difficult for the Senate to actually pass their bill because they have less of a Republican majority. They have 52 Republicans. They have to have at least 50 go along with this to pass it, right? And then our vice president would be the tiebreaker to get this passed. Now, we've already had one Republican senator say he's not going to vote for it, although unless certain changes are made. There's other ones that are not sure whether they're going to vote for it. So this is a much tougher thing. But let's say it does pass. Then we have a House bill and a Senate bill, and they're both different. So they need to be reconciled. They need to be adjusted into a single bill. Both chambers would need to pass it, and then the Senate would need to sign it. This is what they're trying to do between now and year end, because all of these things would take effect in 2018. What that means for you, though, right now in 2017, there's still some strategies available that may actually go away with this new tax act. So if you're not sure what they are or whether they impact you, give us a call for a free assessment. We'll go over them with you and see what strategies are important for you to implement between now and year end.